Hey everyone, I'm Alex50, and I retired at 50. Today's video is called, Where Should You Invest? US Stocks or International Markets? My subscribers forced me to make this video. Why? Because in the comments, I constantly run into replies like, He's insane, an idiot, suicidal, he's definitely going broke, he can't read, he has no diversification. Look, people with calculators are trying to prove that I don't exist. That's at least amusing. I trust my own eyes, my own personal experience, and I've been investing since 2008, and my Excel spreadsheet a bit more than the opinions of strangers, especially those who don't have their own experience behind them. And now I'll try to answer all these skeptical comments. But before I answer, I want to warn you about something. Notice that my video isn't about whether you should invest in US stocks or international markets. It's about needing to digest every idea, including investment ideas, even if the idea seems absolutely logical, understandable, and smart. You need to chew your food. Now, the actual answer to the question I posed in the video. This debate about whether US stocks or international stocks are better is completely meaningless. Both are better. As paradoxical as that may sound. Why? Because what matters first and foremost is the very fact of investing, not which instruments we choose. If I make an analogy with health, again, what's important is that we show up at the gym and start moving. Movement is life. What will we do there? I don't know, squat, box, wrestle, run or walk on the treadmill, or something else. It doesn't have some defining significance because all of those things are useful. And I'll quote a thought from the famous writer and investor, multimillionaire Morgan Housel. In one of his recent articles, by the way, I recently posted it on my Telegram channel, he made this wonderful point that nobody criticizes marathon runners for not looking like powerlifters. There's no powerlifter with huge biceps standing over a marathon runner saying, Buddy, you're training wrong. You need to squat properly, do bench press, deadlifts, and so on. Although both the powerlifter and the marathon runner are athletes. They're just each playing their own game. But when we start talking about investments, this logic completely breaks down, because everyone will definitely jump into the comments and express their opinion that you're doing it wrong, I don't know, squatting wrong or whatever. That's at least strange. I want to draw readers' attention to the following. I'm not trying to prove that my position is stronger, more profitable, better. I just want to explain that I'm playing a different game. And in today's points, I'll try to prove this position, this thought of mine. First thought. I'm going to show a comic for my daughter about a fortune teller. Imagine this situation. You're walking down the street, staring at your phone, and a fortune teller runs up to you and says, Trouble awaits you. Let me tell your fortune. I'll tell you how to protect yourself from this. What do you do with such a fortune teller? You push her away, tell her to go to hell, and go about your business. But this logic starts breaking down again when we dive into social media and start watching investment videos. What do we see there? We see scarecrows, various doomsday prophets, pseudo-gurus who plant ideas in our heads like, I don't know, the country's heading for disaster, we've got 10 to 15 years left to live, the country will break into many pieces, America is heading for Venezuela's fate. And we memorize these cliches and stamps without digesting them, and then we start broadcasting them in other places, in articles, blogs, and so on. I understand this logic. People just love listening to stories about how the world's going to hell. They just love it. Such articles, comments, videos get the most likes. If you want to become famous, just record a YouTube video about how America is heading for disaster, and you'll definitely get your 10,000 views. But I urge you to always ask questions. Who's voicing this opinion? Usually it's a scarecrow. Moreover, a scarecrow that seems very smart, well-read, educated. And if we turn to the classics, Taleb has this meme about skin in the game. He argues that if you're listening to someone's financial advice, you need to understand whether the person giving this advice is answering with their own money, their own capital. If the answer is no, then their opinion, the value of that opinion, is zero. And according to the logic of this scarecrow, if a video comes out saying the country's heading for disaster, what should they do? They should either buy a cabin in Montana, ammunition, a goat, and canned food and move there. Or option 2, they should leave the country. But they don't do either. So what do? They do exactly the opposite. They get paid per word or per show. They spend money from our cursed economy on various goods. Even if they left, it often happens that they still continue to serve clients from America because nobody needs them there. And most often they just stay in America because they understand that here they're a big fish in a small pond, and there they'd be a low-level clerk. And again, the question arises, should you listen to such a scarecrow? Next thought. Look, investors very often don't see risks. There are risks they work with that are described in textbooks, quoted from article to article. I know about these risks. I'm ready for them. I've studied them. I understand them. They're completely clear to me. There are market risks. There are country risks. They're completely clear to me. And when you watch videos from many investors about working with risk for, say, an American investor, it looks like this. Buy international stocks because they're more reliable and probably more profitable. Open an account with a foreign broker, preferably one with the initials IB. Buy an international index. 3 tips for diversification. But colleagues, this approach has nothing to do with diversification. This is a bet on one region, and a region that may not always align with our interests. People don't try to rethink this advice. Don't try to engage critical thinking. They just swallow it and, again, start quoting it like a stamp. I have an example. I borrowed it from an investment company analyst. He gave this wonderful example. Imagine an investor who gets on a plane and sends their capital, a suitcase of money, on a neighboring flight for safety. And our investor's flight, the moment our investor boards, crashes. The flight attendant is screaming, passengers are screaming, but the investor is happy that their money flew on a different flight. What happens next? Their body is now falling to the ground at high speed. This is an absurd picture, but this is exactly how many American investors work with risk now when they try to move all their capital to one location. At the same time, there are risks that are written about in textbooks and aren't discussed at seminars because people simply haven't encountered them. I don't know, scams of investors and business people in various countries. I've been affected, my friends, my acquaintances have been affected. If you haven't encountered this story, just Google it. You've probably never encountered the compliance of foreign banks when they just beat you with your passport, or rather your tax residency, and consider you a third-class citizen. I'll give you an example of risk again. There's our beloved broker Interactive Brokers that everyone screams about from every platform. Invest through this broker, it's the most reliable, there's insurance, blah 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 blah. Well look, again, take people from certain countries. They've already been banned. They became undesirable, and accordingly can't open accounts with this broker. How are we different from them? Sooner or later such a scenario may happen where we also become undesirable. And what will this broker do at that moment on orders from their government? It's very simple. Of course they won't confiscate our capital. They'll say, "Dear investors from America, please sell all your assets, withdraw, or try to withdraw them, but there will be nowhere to withdraw them to." And what will you be forced to do? Scenario 1, you'll be selling them at highs. When you have big profits, you'll get hit with giant taxes. In my case, I actually calculated this, these would be huge taxes. Or option 2, if at that moment some crisis is raging, you'll be taking losses. They're telling you, take your money, sell your stocks, take your money. I don't want to sell my assets in a year, or 2 years, or 3 years, or 5 years on anyone's orders. Again, the conclusion here? Keeping all capital there is also insanity. Thinking that you opened an account with one broker in a country that doesn't particularly love our citizens, well, that's at least strange. Moreover, this thought, I'm now looking at our wealthy elite. They supposedly have 3 college degrees. Not all of them are smart people. There are different people, let's say, but they've already understood this thought. They understand that storing 100% of capital in foreign jurisdictions in current realities is insane. At least some of the money needs to be kept here. We were talking about risks. Again, there are other risks related to price, to market risks. For example, people very often love to bring up a certain tech stock. What do you say about buying tech stocks at $350 per share? People bought them at the very highs in 07 to 08, and they still can't recover their costs on those investments. They're still crying. Colleagues, once again, when you hear such a comment, this investor doesn't understand what they're talking about. This isn't an investor. Before you is anyone, but, I don't know, some journalist or blogger observer. Someone who simply doesn't understand what they're talking about. Why? I'll explain. Because the comment about that tech stock is valid in one case. Some hypothetical failed investor takes their capital, all their capital, 100% of capital in 2007, dumps it all into one stock at the peak of the hype, and then everything falls, and they're crying. In reality, it doesn't happen like that. Well, actually it does happen, of course. Such a scenario can exist. When we have some trader gambler addict who for fun dumps their entire deposit, several tens or maybe hundreds of thousands of dollars, on one stock that they promised would double or triple. And then there's a crash, and they lose everything. And then for 12 years they walk around the internet telling everyone that stocks are a scam. What does their action have to do with investing? Nothing. Why listen to them then? Again, if we give examples, besides that one stock there was Bank of America, look at its chart, there was Freeport-McMoRan. Many others, dozens of companies that have grown significantly since then. Why that specific stock? I don't have just one stock in my portfolio. If you look at my portfolio average, the numbers make you want to clap your hands. You'll say, well, okay, one stock isn't an indicator, go look at the Russell 2000 index. It hasn't really grown since 2008. That's right. But again, most of you are beginners. Your capital isn't formed yet. For you, frequent corrections are a blessing. Frequent crises are also a blessing. The absence of growth is also a blessing. Why? Because, once again, capital isn't formed. You have a time horizon of 10 to 15 years during which you need to accumulate capital. And accordingly, you should pray that this market doesn't grow during this entire period. Because I, for example, don't envy US investors right now. Imagine, I put myself in the shoes of an investor who realizes and understands that I need to buy this with payback periods of several decades, maybe even hundreds of years, with microscopic dividends, hoping that everything will continue to grow. I don't need that. I don't envy investors who are just now entering current Western markets. Now another very important point. Again, people love to show us index charts. When I look at them, I'm just outraged. Once again, colleagues, your personal accumulation chart will not coincide at all with the index chart. Because, as I've already said, capital is made outside the exchange, at work or in business, on the career ladder. You'll accordingly have systematic purchases with a high salary. This salary will most likely grow if you're doing everything right, if your business is thriving, and so on. I, for example, had business sales. Boom boom, a business sells for, I don't know, say, $100,000 to $150,000. I load that $100,000 to $150,000 during some correction in the American market and thereby lower my average. I sold liabilities. I've already talked about this in articles on this topic. I've posted videos where I showed that I sold an apartment, sold a country house. Right now I'm selling my parents' foreign real estate, an apartment in Montenegro. All these liabilities go into the market and accordingly increase my capital significantly. We'll naturally buy during crisis because, again, I have March 2020 when I entered with a decent share of capital that was placed in bonds. Plus, I sold my last studio apartment. Since then, I don't know. I'm up 40% on my portfolio from where I entered. Now again, there are many different studies, including Western studies. I'll try to show a picture on screen now. Over a long horizon, studies were conducted even in the most brutal periods. An investor who tries to save for the long term, more than 20 years, with a probability close to 100%, still gets rewarded. They still end up in the black. This is also an important point you should remember. Next point about dollar-denominated assets. Often there's this comment, you have dollar-denominated assets. That's probably wrong. Again, I patiently explain to people, I say, colleagues, I don't have dollars. None at all. Like, I don't know, I have some certain amount in my emergency fund, in a savings account that's enough for 6 months, a year of life, and that's it. I don't have dollars. I have shares in businesses. Many of these businesses are exporters with dollar revenue. In case of currency fluctuation, what happens? The dollar grows, exporters' revenue and profit grow, my dividends grow. I start earning more in dollars. Ask yourself, why does our government, our state, our economists start this currency adjustment? To balance their budget. They need to feed government workers and retirees. How do they do this? Including through dividends they receive from exporters and through taxes. They basically take this profit. If I join an exporting company, I benefit from currency fluctuations. It's not scary, it's not my enemy, it's my ally. Accordingly, if we talk again about currency fluctuations, you'll say, well, how can you consume foreign goods or travel abroad or something? Again, I explain, colleagues, I'm located in the suburbs of a major city, I live in America, I have dollar income and expenses in dollars, not in euros or yen. And my return on investments now far exceeds my expenses and personal inflation in dollars. I emphasize personal, not the government CPI, not some number journalists sang to us on TV, but my personal one. I calculated it myself. I look at how much I spend per month. The amount is specifically known. I've been keeping a budget since 2006, and I look at the growth of my dividend salary. Dividend salary grows faster and capital has also increased significantly since then, but expenses don't grow at that rate. Again, currency fluctuations affect the cost of foreign goods for me, that's right, but for me this is reflected in inflation. I just start paying a little more for certain goods and services. But again, if you look at my consumer basket, it differs from the average American. For example, food in my basket takes up a negligible share. For many people it might be half of all expenses, but for me it might be 10%. If tomatoes doubled in price tomorrow, it doesn't mean my personal inflation doubled. Many goods or services in my basket are actually deflating. I could list them endlessly. I don't know fitness. Recently bought a gym membership, paid some ridiculous money for it, looked at expenses for the same gym 10 years ago, exactly the same amount. That's deflation. What else? Transportation. Through simple reasoning and actions, what did I do? I calculated and realized that Uber plus Subway costs me way less. I sell my personal car and my transportation expenses are cut by a third. I made a separate video about this. And I could list many more. Entertainment, communication services, internet, and so on. Many goods and services in my consumer basket are actually deflating. Home appliances with the appearance of Chinese products, Amazon, and all this other mass market stuff. I've started saving a lot on all these devices. On phones, on some technology, on something else. Prices don't grow that much on them. Look, another argument that's often given in comments. Well, listen, US stocks are more profitable, aren't they? No. Here's a website. I'll put it in the description now. Portfolio Visualizer. Here's a screenshot I'll try to show now. This screenshot, the range is from the early 2000s. US stocks by profitability beat international emerging market stocks. You'll say, some unclear website. A colleague also calculated this. He counted from the late 90s. Again, according to his research, U.S. stocks outperform international stocks in profitability. What do investors tell us in this case? Adherents of international stocks. They say, well, you took the wrong time horizon. Back then in America, 2003 to 2007 was an anomaly, high commodity prices, and that won't happen again. Look what happened the last 10 years. Yes, I saw that indeed the last 10 years the American market has outperformed international markets. That's right. But who said America won't have new doldrums now? Considering that everything is being sold at insane prices now. Why do people think we won't have another commodity boom? Do you have such confidence? I don't have such confidence. And now the most important thought again. So there aren't accusations that I'm shilling for U.S. stocks. Once again, smart books, smart articles, including Western articles, tons of studies already. Please look, read, where it's written that the returns of developed and emerging markets over the long horizon roughly equalize. There's no serious delta or difference there. The difference is fractions of a percent in annual returns. And then I ask myself, if I know that the last 10 years the American market has done well, but I know that over a long 20-year horizon everything will more or less equalize. Americans will do okay, and emerging markets may be a bit better, then why would I bet specifically on the American region that I understand well? And I made a conclusion for myself why I'm currently also in international markets. I'll explain. Let's return to where we started, that everyone in the investment field is playing their own game. When you try to explain to a marathon runner that they need to squat, press a barbell and do bench press, or rather deadlifts, well, that's strange advice. My game is as follows. I invest like a farmer. I have cows in the herd, several cows. I want my cow to give milk every day. If some cow dies, my herd still has dozens of cows. Besides that, there are also chickens, goats, and sheep in the herd. That's my investment strategy, absolutely clear. And now we ask, can a farmer feel just as comfortable in other markets right now? I, for example, can't feast on dividends from certain high-priced stocks if I buy them at current prices. Get 1.5 to 2%, believe that the cow will gain weight. I don't want that. It's psychologically painful for me. I need it to give a lot of milk. And the fact that it might double in size, I don't want to slaughter it later. What else don't I want? I don't want to buy a business that will pay back after my death. I won't wait 50 to 70 years. I don't like investing with the crowd. When everyone from every platform says that first-class American stocks are the best, buy only them. For me, that's crowd psychology. I know that sooner or later these guys will suffer. They'll go under the knife. And, for example, international emerging markets that everyone dislikes now, including local investors, saying, "Ugh, it's a swamp there. Nothing's clear, everything's bad, bad returns." That's actually very good that they're shouting about this market right now. Then I don't understand the risks of certain American companies, unlike the risks of our domestic companies. Here everything is clear to me. There's state capitalism. Everything's clear there. We understand the motivation of all these managers. The motivation of the state is clear. It's clear where they're all going. Everything's completely clear. What's in their heads, I have no idea. And to study the risks of those companies, I don't know, you'd have to become some super pro, stock analyst, dive into these several 15 to 20,000 American companies, sift through them. I don't have that much time. In this regard, our swamp is simpler and clearer to me. You'll say, so then you absolutely don't need country diversification? Well, of course it's needed. It's just needed for something else. It's primarily needed for so-called rivers of fire, when some disaster happens in your region that completely changes the arrangements of what was in your location. Well, I'll give an example. The conflict in 2014 in eastern Ukraine. My friends and acquaintances, when they overnight, investing only in their region, lost practically everything. In their case, of course, if they had paper assets in other locations, they would have barely noticed that crisis. But again, If we take, for example, if they even just kept part of their funds not in real estate but in paper assets of their country, even Ukraine, considering it went who knows where, Ukraine's stock market has tripled since the lows. They would have managed to recover anyway, while their real estate remained unclaimed, especially commercial real estate in that region. It stayed unwanted by anyone. Now my main question. A river of fire, say revolution, war, or something else. Who told you this river will be in our region again? Why specifically with us? Why not in Europe, not in the US, not in Asia? What will this river be, we know? It'll definitely be war, revolution. We're always preparing for the past scenario. But our current scenario showed that there are also pandemics, when the whole world goes crazy at once. Moreover, some countries went crazier than our officials. And when this river of fire will be is also unclear. I ask myself, personally standing there, looking at Excel and asking myself, when will I need country diversification? At what moment? And what is proper diversification for me? Well, probably when my capital reaches several $1 million, about $5 to $10 million, then at that moment we could, for example, allocate part of the funds, I don't know, $1 million to foreign assets worth $2 million. That would already be justified. Again, I want to invest around the world. Not in the US market, not in S&P 500 indexes, but I understand that diversification is different economies. That means making bets on Asia, some China, Indonesia, Japan, and so on. I definitely need to bet on Europe, Germany, and other countries, France. I need to bet on Latin America, on emerging markets like Turkey, and so on. It should be such a wide front of different instruments. That's one. Second point, if I invest around the world, I need to roughly estimate dividend yield. I looked at it. It's quite modest there, a few percent. In current realities with my capital, I won't have the chocolate I have now. It'll be significantly less in dividends. I'll probably lose by half. This cash flow, the milk from the cow, will simply be cut in half in absolute terms. And when capital becomes large, say, $5 to $10 million, at that moment my dividend yield from the whole world, all regions, emerging and developed countries, will cover all my wants and even exceed them. Then, yes, then it probably makes sense to transition to investing around the world. Another important point. Besides all these thresholds and market risks and returns, you also need to understand that there are risks not just for my capital but risks for my body. For me, as an investor physically. And with these risks, investors who sit there, people open an account at Interactive Brokers, deposit $20,000 there, and think they're so protected. Nothing of the sort. A proper investor, how do they protect themselves? They protect themselves not only at the capital level, but also at the level of themselves and their loved ones. What is that? It's a passport. It's proper tax residency. It's a backup airfield in the form of real estate somewhere in another country where they think it'll be safe. And so on and so forth. You can list these risks we're not protected from for a long time. And again, if I ever come to this, I'll understand that betting on just one region, well, that's stupid, that's not diversification. That's everything I wanted to tell you today. I urge viewers to like and comment on this video. Why? Because it helps me convey my ideas get into recommendations, and accordingly more people get acquainted with them. Naturally, I urge you to subscribe to YouTube itself.